Almost a year ago, we took a look at two brand new ETFs that promised something that no other exchange-traded fund or stock had ever touted before, which is that these funds would be able to distribute dividends to shareholders every single week as opposed to every month or every quarter like most dividend stocks and ETFs. Before these funds were launched, no other fund manager or publicly listed corporation ever had any kind of security that promised distributions on a weekly basis. At the time, these funds were so brand new that we didn't have much data in terms of their performance. The first weekly dividend ETF was launched on October 1st of 2020, and the other one was launched just a few months later in May of 2021. Now that we've been able to observe the performance of these ETFs, in today's video, we're going to take a look at both of these two weekly dividend ETFs, and we're going to run the numbers and determine if these ETFs are any good, and maybe if they're worth considering for your own dividend portfolio. We'll also compare the performance of both of these funds to see which one has done better than the other. So with that being said, let's go ahead and get started. The first weekly dividend ETF we're going to take a look at is the SoFi Weekly Income ETF, which trades under the ticker symbol TGIF, which is pretty cool. This was the first weekly dividend fund launched back in October of 2020. As you can probably guess, TGIF pays out dividends to shareholders every single Friday. TGIF seeks to provide weekly income by investing in investment-grade and high-yielding fixed income securities. This ETF consists of roughly 154 bond investments with a duration of 3 years or less in order to help reduce interest rate risk. It's an actively managed fund as well, meaning that fund managers handpick what goes into it as opposed to a passively managed index fund. TGIF currently trades for $97.17 per share as of the making of this video, and if we look at the fund's distribution history, we can see that it's been distributing a measly 5 cents per share every week since being launched. If you notice, back in December of last year, TGIF actually paid a weekly dividend of $1.49 per share. I haven't been able to determine definitively why this extra large dividend was paid, but I think I might have an idea that I'll go into in a couple of minutes. To date, this is the only time that this ETF has ever paid more than the standard 5 cents per share in any given week. Yahoo Finance also doesn't give us a dividend yield for this ETF, which might have something to do with their website not being able to calculate dividend yields for a fund that distributes dividends weekly. Other websites like Seeking Alpha and Google also don't provide us with a dividend yield. So in this case, we'll have to calculate it ourselves. The formula for calculating a fund's dividend yield is to take the annual distribution amount paid by the fund and divide it by the stock's current trading price. Since this fund pays 5 cents per week and there's 52 weeks in a year, that means that TGIF pays roughly $2.60 for every share that you own. If we divide that by the trading price at $97.17, we get a dividend yield of 2.67%. If we wanted to include that one-time distribution of $1.49, that would give us a yield of 4.15%. I really don't like to take into account these special one-off kind of distributions when looking at a dividend yield because they're one-off situations. So in this case, I'm going to assume that TGIF has a dividend yield of 2.67%. This obviously isn't a great amount considering it's such an expensive ETF at over $97 a share. To date, they haven't been able to grow that dividend any, and I really don't anticipate this ETF being able to provide much growth in their distributions over time. I think SoFi is probably going to look to keep that dividend amount pretty consistent, and besides, growth isn't one of the fund's objectives on their website or in their summary prospectus. If we take a look at what's inside this fund, we can see that it holds pretty much all short-term corporate bonds. As of April of 2022, this fund holds approximately 154 different bonds that are all diversified across many different sectors. You can see it has bonds from some companies I even talk about regularly on this channel, like Owl Rock, Starwood Property Trust, and Prospect Capital. Plus, it also has other large company bonds from companies like Ford, General Electric, and Roblox, to name a few. But by now you've probably realized that corporate bonds don't pay investors on a weekly basis. These kind of investments typically pay out on a quarterly basis. So how is TGIF distributing dividends every single week? I'm assuming what this fund does is simply hold on to all the cash that's paid out from these bonds, and they're choosing to slowly distribute the dividends over time. My theory is this is probably what explains that massive dividend from last December. It happened during the last week of the year, so what I assume happened is TGIF probably had some additional earnings from some of their bonds that exceeded the typical 5 cents per week, so they just gave shareholders an extra large dividend that week. But if you notice, this fund didn't do that back in December of 2020. In the last week of that year, it only paid out 5 cents per share like usual. So who knows if TGIF will be able to pay out another large dividend during the last week of this year. Personally, I never like to assume that an extra large distribution or even a special dividend is going to be paid out, since these things are usually impossible to predict. So I wouldn't suggest trying to buy a whole bunch of shares during the last week of the year in hopes of trying to get an extra large distribution. The second weekly dividend ETF we're going to take a look at is the SoFi Weekly Dividend ETF, which trades under the ticker symbol WKLY. This was the second weekly dividend ETF ever created, which was launched back in May of 2021. This fund is pretty similar to TGIF, so I won't spend too much time discussing it, but WKLY seeks to provide investors with consistent income by tracking the SoFi Sustainable Dividend Index, which is made up of the most consistent dividend-paying companies globally. Unlike TGIF, this fund is passively managed as opposed to being actively managed. Looking at the holdings for this fund, we can see that this ETF holds 446 different holdings, which is much greater than TGIF, and unlike TGIF, this fund holds securities as opposed to corporate bonds. According to SoFi's website, this fund holds the most consistent dividend-paying companies globally, so there are a lot of international companies in here like Mitsubishi, Tokyo Gas Company, and Vonovia. I did have to do a double take at some of these holdings though. For example, Zim Integrated Shipping is on this list, but they've only been paying dividends for about 9 months so far, so I'm not really sure why they're considered a consistent dividend company if they literally just started paying dividends. Both of these ETFs have a couple things in common that are worth mentioning. For one thing, they both have slightly higher than average expense ratios, which is something I know a lot of my viewers really pay attention to. WKLY has a 0.49% expense ratio, and TGIF has a 0.59% expense ratio. According to Morningstar, the average expense ratio for an ETF is 0.23%, so with the luxury of getting these dividends every single week, you are paying a higher fee for the privilege of those frequent distributions. TGIF has the higher expense ratio of the two because it's an actively managed fund. Because fund managers are handpicking what goes into the fund, the managers have to be paid. This explains why you have to pay more for this ETF. Another thing these funds have in common is that both of them have seen their share price decline since their inception. TGIF started trading at $100 a share, where today it now trades at $97.17 per share. WKLY was launched at a price of $50 a share and now trades for $48.97. So if you were hoping for share price appreciation, it just hasn't been there yet, and taking into account what's going on in the market right now, it means that things are probably going to continue to be pretty volatile for a while. If we compare these two funds to see which have done better over the last 11 months, we can see the results haven't been too good for either. The best performing weekly dividend ETF so far has been WKLY, which is also the oldest fund. If you would have invested $10,000 into WKLY and chose to reinvest your dividends, you would now have $10,122, which means you'd only gain $122. Had you not chosen to reinvest your dividends, you can see you actually would have made an additional $2. This is because the share price of WKLY has kept falling, and as a result, reinvesting your dividends would have meant you'd lose money on everything you were putting back into this fund. The results are even worse for TGIF. A $10,000 investment would have you looking at a total net loss of roughly 5.67% if you reinvested dividends, or a 5.54% loss if you chose not to reinvest your dividends. The reason for only looking at the past 11 months for each of these two is because TGIF was launched 11 months ago, and it obviously wouldn't be fair to compare both if one started earlier than the other. And remember, both of these ETFs are charging higher than average expense ratios, so you'd basically be paying a premium to either underperform or even lose your investment a little bit. I know it's a relatively short amount of time, but so far the results just haven't been there yet for these funds. TGIF did start at a really unfortunate time seeing all the market volatility we've been going through as of recently, but with all things considered, these funds just don't have any benefit besides a weekly dividend in my opinion. And given how small of a dividend yield these funds offer, you'd have to invest a ton of money in order for the weekly dividends to be of considerable amount. I personally think that these ETFs are mostly just a gimmick, and there's plenty of gimmicky ETFs out there. Not too long ago, I saw an ad for an ETF called the Life Goal Homeowner Investment ETF by a company called Life Goal. The fund provider tries to advertise this fund as being the perfect place to park the money you've been saving for a down payment on a house. If you look inside this fund, you can see it holds a lot of hardware stores, construction companies, and even REITs. But this ETF is completely unnecessary. If you're looking for a place to build wealth so you can build up enough of a position for a down payment on a home, just put it in a low-cost index fund. And actually, given this fund's performance, if you put your down payment savings into it, the only house you'll be able to afford a down payment on is for the poor house. So don't waste your time with these gimmicky ETFs unless weekly dividends just mean the world to you and you're willing to put up with a lot of underperformance. If you have millions of dollars to invest, then it might be worth it when the market recovers, but there's so many other better dividend ETFs out there that are more diversified, have longer track records, and have some growth in terms of their dividends and their share price if that's what you're looking for. But again, that's just my opinion. If you like weekly dividends and you're willing to put up with what I just mentioned, then it's completely up to you. Alright everyone, that's going to wrap up today's video. Thank you all so much for watching, I really do appreciate it. If this video benefited you in any sort of way, please click the like button below and click subscribe if you want to see more dividend investing strategy videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content, and I'll continue to provide you all with that content. Alright everyone, thanks again for watching, and I'll catch you next time. Take care.